Hi, everyone. Thanks for coming today. My name is Molly Fadul. I'm with Cephas Partners. I'm a traditional real estate private equity investor, and I found myself in the world of technology, investing in companies, including blockchain strategies, as well as other technologies that apply to the commercial real estate world. So I'm happy to be moderating this panel today about tokenizing everything, literally everything. So we're going to hear from the four panelists here. I'm going to have them run through a quick bio so you can get to learn a little bit about them, and then we'll have some questions. And at the end, we'll have an opportunity for you all to ask any questions that might come up throughout the discussion.
Cool.
Go ahead.
Yeah, thanks for having me here. I'm excited as well. I also come from a background in real estate, commercial real estate in particular. But now I'm the head of business development for LeadBest, and we provide full service solutions for anybody going through or has gone through the token issuance process. So.
Hi, my name is Ami. I'm the founder and managing partner of Spice VC.
Oh, there you go.
Some music.
Yeah.
We are the first fully tokenized fund. We tokenized our own VC fund. We started doing that about a year ago before tokenization was, before security tokens were popular. And when we did it, there was not a lot of infrastructure for things like that. So we paid lawyers a bunch of money, and we built the technology ourselves, which later became a company called Securitize. Some of you may know. It's a major company in the space. And so we have first-hand experience of tokenizing ourselves. But not only that, we focus the entire fund to invest in the tokenization ecosystem. So we have 7 investments so far. We launched our token in March. Since then, we invested in 7 companies, mostly around the ecosystem of tokenization, because we think this ecosystem is going to be huge. Like, everything's going to be tokenized.
I agree with that. So I'm CEO and co-founder of Abstract Tokenization. We're building an end-to-end platform for commercial real estate sponsors to automate the legal, operational, and technical functions of running an STO and raising capital that way. My background is 9 years at Merrill Lynch, and also a technology entertainment company that I started that's still operating throughout the world in the UK and the US and so forth. We did seed upgrade technology. One of the first ones to integrate with Ticketmaster and their APIs.
Hey everyone, I'm Jesse Tevelo. I'm one of the co-founders of Block Team Ventures. We are an investment firm and advisory, also have advisory services. We run a fund called the Blockchain Innovations Fund. As you can probably guess, we invest in blockchain-enabled companies.
All right, great. Ami, we'll start with you. You guys have digitalized your VC fund. Could you define for the audience what a digital security is?
A digital security is just a regular security, but it's in a digital form. I'll give you an example. I was an entrepreneur many years, and I started companies. So when you used to start a company, you'd bring in your co-founder, and everybody goes in and sign a document, and that's your first document. And then the first investor comes in, and everybody goes in again and sign another document, and then another document. And this mountain of documents is what defines ownership in a way. And there's no one place. Even the cap table doesn't mean anything, because you have to look in the details. Who's entitled to get what, when, right of first refusal, and this and that and the other. So by tokenization, what we're trying to do is try to take this mountain of paper and turn it into a token. And the token includes the rights of the token holder. It's a security, like the papers are a security, it's a security. But once it's digitized, it can move much more slowly, much more freely. It can flow. So it means that you can have more tradability within regulations. So in some cases, you can sell to everybody. In some cases, you can sell to groups of people. It changes from place to place in the world. But generally speaking, it becomes much more tradable. It's also much more flexible, because the rights of tokens owners can be programmatically changed. You can create smart contracts that make all sorts of new ways of doing things. And also, it becomes almost immediately global, 24/7, instant settlement. So we're taking an industry, the ownership industry, which was used to, outside the public market, be in a position where if you wanted to trade something, you need a lawyer in 3 months, something that you just moved the token, and that's it, it's done.
Great. And Abel, could you help us understand the difference between utility tokens, security tokens?
Sure, yeah, so from our perspective, we look at security tokens, also called tokenized securities or digital assets, And there's a couple things. One, we're looking at them and we want to see them be asset-backed. And so actually tied to the ownership or a revenue or profit stream from an underlying company or asset. Number two, sort of like Ami referred to, we want it to be compliant. And so, SEC compliant and security laws compliant, and as well as the regulations. And so for us, the other piece that's really important is actually investor rights. And so having, whether it's liquidation preferences or specific rights that spell out this is what you as an investor are entitled to for holding this token, we think is a very important piece for the evolution of tokenized securities. Compared to a utility token, which is more so an access to a protocol or platform, and typically doesn't carry really any investor rights or a claim on ownership or revenue or profit stream. And so coming from, my background is institutional capital at Merrill Lynch and managed almost $1 billion. And coming from that standpoint, working with institutional investors, corporations, endowments, foundations, there's specific qualities that need to be, and pieces that need to be met for it to even qualify to be held by these institutional investors. One of those big things is digital asset custody, which I think we'll talk about more later.
Great. So you guys have touched on some of the benefits of digital securities. Paul and Jesse, I'll ask you, do you have anything to add in terms of benefits of tokenizing a security versus owning a traditional asset?
If you want to go ahead.
I was just going to say, it's the way that I look at this is that we're in sort of this hybrid world now where these different types of asset classes that are coming onto the scene. And, typically for me as an investor, you're looking at, in the old days, you're looking at venture or equity. Now there's these new opportunities that have their pros and cons. And I like to believe that we're entering, and we were talking about this backstage, sort of this hybrid model where you have these different types of asset classes that hopefully we can kind of all play in all of them. I tend to like the projects where I'm seeing this trend of sort of an offer for, hey, you can have some equity in this project. We're also offering maybe a security token, maybe a utility token, maybe both, right? And a security token, which we'll probably get into a little bit in this talk, there's lots of creative ways you can use that or initiate that with the smart contracts and how it might initiate different types of triggers that allow the investor to get back in some type of return. So I think that's just a little more color around these different types of assets. And it's an interesting place that we find ourselves in. There's still a lot to be figured out, but I think this hybrid model is one that we're going to see continuing to be a trend over the next 6-12 months.
Yeah, I'll answer it kind of backing that up, and I would say, though, bifurcating the issues, kind of like, what are the benefits right now? I would say there's not a lot, because our ecosystem is so young, and there's only a few, Spice being one of them, security tokens that actually, trades in a digitized format. The potential is just through the roof, but it's going to take a while for us to get there. But the one thing that we got to be careful about as a community is making sure that we understand the risks, the negatives that go with it, because there's a lot of negatives that come to basically making your company a public company from day one. So that's what I spend a lot of time just trying to limit, make sure that those risks are avoided. But yeah, there's lots of opportunity, liquidity, transferability to individuals, interacting with the things you own across borders. It's phenomenal opportunities.
So practically speaking, Abel, let's apply this to real estate, which is the largest asset class in the world. What is some specific benefits you can apply to a real estate owner who's looking to potentially digitalize their assets?
Yeah, I think you hit it on the head, right? Liquidity is the chief concern of commercial real estate investors, especially institutional quality commercial properties. They typically come with anywhere from 5, 7, or 10-year lockups of your capital. The cost of illiquidity, economists sort of say it's between 15 and 30%. And that includes opportunity costs as well as right now a lot of the sort of one-off secondary opportunities to get out of a 7-year investment into institutional quality commercial real estate has a huge discount on your sale price. And so creating liquidity is number one, and not just liquidity, but actually 24/7 trading and transferability liquidity that that can actually be utilized by an entire new global capital pool. So international investors, whether they're accredited or not accredited, can now come in under Reg S. And so it opens up a large, an additional capital pool, and then also access. And so typically these sort of institutional quality opportunities come at a pretty high minimum. And with, by fractionalizing the ownership of these commercial real estate properties, we're able to reduce the access, barrier to entry, which I think is also very important in the space for diversification.
Good. Ami, you've actually done this. Can you tell the audience how it is that you go about putting a fund or an asset onto blockchain to be issued as a security token?
So it's different now than it was when we started. Now there are quite a few service companies out there. I have investments in some of those. So for example, if you have a major big project and you want to tokenize it, then Securitize is one example. If you have a small kind of company that you want to raise a small amount, maybe a company like a Start Engine, things like that. And on the real estate side, we have a company called Slice. So there are service providers out there. And I was here 6 months ago, and I was talking about this STO market and how it's going to work. And there were maybe 4 companies in the space, 5 companies in the space, and now 6 months later, we are approaching 100 companies in the space. So today, it's a lot easier than it was. If you want to tokenize something, just go. There are experts out there. Pick the one that's right for you, and they will help you do it. What I would try to suggest is not to do it alone, because it's quite complicated. At least now, until everything is going to be more organized and more commoditized. It's still in the early stage. I would advise now to tokenize, especially when you see your advantages. Now, what I'm seeing in the market right now is the supply of companies that want to tokenize or entities that want to tokenize is effectively endless. Mm-hmm. It's very easy. It's very easy decision to want to tokenize something. You have something that's not liquid, and you can make it liquid, and you can make it worth more money. Why not? Okay. The problem with this is that the demand has not come yet to meet the level of the supply. So the demand is going to come from institutional investors, and the demand will require more infrastructure, more trust, more time, more education, and things like that. So at this point in time, it's companies that want to tokenize or assets that want to tokenize need to know roughly where the money is coming from, where the investors are coming from, because these are not the old ICO days. It's not like you raise your hand.
Right. Mm-hmm. Well, to that end, I think there have been some assets that have recently been tokenized, especially in the real estate space. I know, Jesse, you mentioned potentially the music space, but Abel, why don't you tell us about some real-world examples of real estate being
Sure.
tokenized or digitalized?
Yeah, so just this month, there's a $30 million Manhattan condo complex that was tokenized. Aspen St. Regis, pretty iconic hotel in Colorado, just tokenized $18 million of their ownership of the hotel. There's European private equity real estate funds that are now starting to tokenize their fund. And so we were starting to see the initial successful adoption by a few early adopters. And I think that will continue as it gets de-risked, right? As other folks looking at doing this and investing in these kind of things understand that, hey, this is working. We've seen a few iconic properties that actually have done this successfully. Now it goes from the 1.5% early adopters to a larger audience that can start adopting.
And so the next big gate that will open is the liquidity, is the exchanges and the trading platforms. They've been announced and they've been promised and they've been delayed several times. But I'm talking to them, I'm working with them on their actual technology, and it's finally getting there in the next weeks and a few months. So when that arrives, it will open another door, because until now it was a promise of liquidity. So for example, we have a real estate company in portfolio called Slice, and what they do is they tokenize real estate in the US, commercial real estate in LA, in Manhattan, and they offer it for offshore, for non-American investors, access to this new market, and they do everything that's required, so there's no tax problems and everything is done, and it's a great market. But the big promise is liquidity, and liquidity is not here yet. So the moment liquidity arrives, I can already see those assets waiting to be tokenized that will flood in, okay? and then there'll be some disappointment because not all of them are top quality, and the demand is for top quality assets at this point in time, and then it will go up again. It's a classic graph of innovation, where everybody's initially at the beginning think that it's already done and it's amazing, and it's not yet done and amazing, but it's going to be there, and then there's a little bit of disappointment, and then it will go up again.
I think just to add to that, I think it's really helpful seeing some of the traditional financial institutions moving into the space, whether it's Fidelity launching, Fidelity Investments launching Fidelity Digital Asset Services for digital asset custody and trading. They've got 13,000 institutional investors that they're basically catering this to. New York Stock Exchange parent company, ICE, Intercontinental Exchange, launched Bakkt, which is a security token trading platform utilizing some of their existing technology, but for specifically tokenized securities, and actually just announced this morning that they'll be launching Bitcoin futures on Bakkt December 12th. And so seeing some of these major traditional financial players move into the space adds a lot of credibility.
Yeah, NASDAQ as well.
Yeah, NASDAQ.
Yeah, and NASDAQ's order matching engine is being used, I think, by a number of exchanges.
They actually announced investment in security tokens.
It's great, yeah.
So it's coming.
Jesse,
coming.
you had mentioned applications to some other asset classes. Do you want to talk a little bit about that?
Sure. Yeah, I mean, this is the tokenization of everything, right? So I think that's pretty accurate. You can tokenize pretty much anything. I think there's some areas that are particularly interesting to me. Music, we have some projects in the music space relating to IP rights and sort of that whole process end to end. It's a very convoluted, complicated process right now. A lot of money is being lost, and it's going into probably the wrong hands in many cases. So I really like that as a way to tokenize something that currently is just a mess, and being able to track it, which is an important part of this whole process and just the whole ecosystem. I think the tracking piece is key. Also, anything you can think of that's creative in nature, art, film, right, TV shows, any kind of entertainment-based content, these can all be tokenized, and it's a great way to fractionalize the ownership of these things, which starts to open up a whole new world of sort of community and sort of mutual investment, right? If you think about a movie, right, you can imagine sort of the entire fan base of a movie owning a piece of that movie, or part of the products or services or concepts that are being talked about in that movie, right? There's all kinds of avenues where you can start to attach some kind of token or value to these types of assets. So pretty interesting stuff. You can get pretty creative with it. I know a little bit of that might sound crazy, but these are possibilities with this technology, which is pretty compelling.
And Paul, you have a background in crowdfunding, and now you're working on projects with digital securities and tokenization. Can you talk a little bit about, obviously, the philosophy behind crowdfunding and thinking about digitalizing or fractionalizing ownership on blockchain are similar? Obviously, different technology behind them, but could you talk a little bit about those dynamics?
Yeah, man, that's a good question, because right now where we are, we're kind of in crowdfunding 2.0, or you could call it 3.0 if you want to call ICO craze, 2.0. But now with security tokens, we're really just taking what got launched in 2012 and then started to get initiated in 2014, which was crowdfunding. And that happened a lot in commercial real estate, right? Security tokens and the blockchain potentially gives us the ability to solve some of the problems with crowdfunding that just exist. When crowdfunding came about, the idea was to provide access to new asset classes, right? A lot of what we've been talking. The problems is there was no liquidity, very hard to transfer, still paper intensive. So blockchain provides a really interesting next step to that, next part of the evolution. I think one thing as a community we need to do is we need to look at what crowdfunding did do well. And as a blockchain community, we need to learn from those lessons. I think we're seeing a lot of projects that just do want to tokenize everything, where that's maybe not necessarily the best case. We found in crowdfunding 1.0, a lot of the assets that the crowd then got access to have just disappeared entirely, right? So that's something that we need to be ultra cautious moving forward on.
I think that's a really good point on this panel, is that you should not tokenize everything, even though you can. Like, that's probably something that needs to be said too here, where it's like, just because you can doesn't mean you should. So think about the use cases, and also just the distinction between, what we're calling security tokens and utility tokens. It's all muddled right now. It's incredibly frustrating for me sometimes. But if everyone can kind of just start to realize that, look, there's these different asset classes, a security is, in my opinion, what it sounds like. It's more secure, right? There's some expectation of return on investment. It acts more as a fundraising sort of type of vehicle in most cases. It can be used in different ways. A utility token, by contrast, is more what it sounds like. It's more utilitarian. It's got some type of function. So if you're an entrepreneur out there and you're thinking about how you're going to use it, just make sure you're looking at what is the actual use case here. And just because you can tokenize everything doesn't mean you should tokenize what you're working on. And if you are going to tokenize it, think about, well, should it be a security? Should it be a utility token? Should I have both? I think there's a lot of interesting use cases where you can use, hopefully, a security token. We'll see how the government regulation comes through. But my hope is that you'll be able to use that as one of your potential options for fundraising, specifically in that channel, in that bucket, and then have another token that's a utility token that you're baking into your product. I think it's much easier to separate the two.
Just one thing I'll add on the crowdfunding side. As you go out, there's traditional CRE sponsors that have 7 investors. Maybe they're private equity guys or institutional guys. And now as they look at exploring using tokenized securities to raise capital and expanding their cap tables, like you said, there's some lessons from the crowdfunding world where, if you expand your capital to 2,000 investors, how do you efficiently manage that? There's a lot of manual processes and inefficiency right now, but blockchain technology like smart contracts and structuring the token properly, you actually build in automated reporting, distribution processing, and so you're actually solving for some of that inefficiency currently in the CRE space or other assets, with investor servicing when it's being done manually. And so there's value added not just on the upfront tokenization piece, but on the sort of maintenance and management of the life cycle of the token. And I think that's a really important piece that sometimes is overlooked, and just how much value that adds.
Agreed. So institutions own some of the most valued real estate here in the US and across the globe. You talked about the deals that they do, and they'll maybe bring together a group of 3, 5, 7 investors, and it's typically pension funds, sovereign wealth funds, very high net worth organizations investing in these assets. What do you think it will take to get those institutional investors interested in accessing this pool of capital? How do you get them comfortable?
I can jump in there. Having spent the first 2 years of blockchain working on real estate tokenization concepts, also I got to say thanks for the shill for Slice, because I have a vested interest in shill as well, or in Slice as well. It's very difficult to get these institutions. I think I've had a call every day since the beginning of this year about real estate tokenization models. There has to be an understanding in real estate of how the debt works. That's the most important piece to any real estate transaction, no matter what, because eventually it needs to be resold, and debt will always be cheaper than equity. The institutions do not understand how blockchain can help them or hurt them. And they also see crypto and they get scared like crazy because they think that that's going to destroy their lives. So the debt is absolutely the most important piece, and very few people understand that. So
it's also, I think, the liquidity piece as well. I think we've had a number of conversations where people are interested, but they're not quite sure how it's going to actually pan out for them, right? They're looking at, well, what's my return? How am I going to get out of this, right? Because they're not as close to the industry as we are, right? We probably have a little bit more the assumption that it's all going to come, right? We're hearing maybe a couple weeks or a month, so we're not sure. So I think that will be a big piece of the puzzle when we can finally start to see some of the exchanges coming out and some options for liquidity that are beyond just secondary market, right? Which is still tough.
I'm going to disagree with that because I think most of the institutions wise up when they look at our industry about liquidity. There's no real, liquidity is not binary, right? It's going to take a long time to come, but in the micro cap markets, which have existed for a very long time, and that's essentially what we're creating, there is no liquidity there, right? And institutions oftentimes don't want liquidity. They actually would prefer the other opposite because then they just deal with the same investors. They don't have to worry about reporting. They don't have to worry about all of these other assets or all of these other benefits that they have to give their investors. So I think liquidity, especially in real estate, is kind of a fox pause that's just it's a great term that we throw out, but in terms of institutions, I disagree. I think they don't want liquidity more than they would. I think the type of real estate sponsors that you see that want liquidity, and this sounds very negative, I'm sorry, but this type of real estate sponsors that want liquidity, just like in the first phase of crowdfunding, they're the ones that aren't bringing the best projects to the table. So it's kind of like a bad dynamic there. So, yeah.
I think that we need to separate between, and that's one of the biggest kind of distinction that I always make between long-term and short-term, okay? And when you talk long-term, when you go to and I spoke to several managers of banks in New York a few weeks ago. You talk to the head of the bank, and you say to them something like, well, I think we can tokenize assets worth trillions of dollars. And they say, yes, of course. Like 6 months ago, they didn't know what tokenization was. Now they're saying, yes, of course, because it just makes sense. And the way that I see it is that tokenization is a technology. It's digitizing something that wasn't digitized before. So if you think about it, music, we had music that was analog, and it was just called music. And then we started having digital music. Mm-hmm. And now it's just music again. All music is digital. I don't know music that isn't digital. So in the same way, I don't think 10 years from now there's going to be a security that is not tokenized. It's just going to be a security. And it's just going to be a security that is in a form of a tokenized. And then as a user of that technology, you can decide whether you want to go for a liquid market or a non-liquid market, but you get all the other advantages of instant settlement when you do want to do it, and you get the international element of it, and you get the much more efficient exchange and all the smart contract capabilities and so on, because it's going to be digital. Mm-hmm. So this is 10 years from now. It's going to be there. Everybody knows that it's going to be there. It's just a matter of building it. Now, we are here at the beginning, and practically 6 months ago, nobody knew what tokens are. So we're 6 months down the line, and we're talking about it like it's already happened. And that's the problem, because it hasn't. Mm-hmm. So we are now in a stage where we have to build the infrastructure for this thing to happen in 10 years, where everything is going to be just a security tokenized. Of course, it's tokenized, okay? So I think what's missing in this infrastructure is a few things. First of all, the infrastructure layer that we're building it on is built on Ethereum, and a lot of them are afraid of this. It was full of scams. It has no connection to the real world that they can trust. So that's one thing. The element of trust itself is not there yet. Those entities in the middle that they trust, the investment bankers, these other entities, they're not there yet, and they're looking at it. They just take time, and they're slow. So every month I'm having this conversation, it just becomes more and more and more interesting from the side of the institutional investors. It's really just a matter of time. In my view. And what I'm trying to do, and the other participant in the industry is trying to do, is to actually, in parallel, build an infrastructure so that when they all just come flooding, okay, the system will not start crashing, because Ethereum can do, 7 transactions a second? It's not going to work, okay? That's why there are other initiatives in the market to actually build it fast enough before the hordes come in. So I don't see it, I see some of the problems you're describing is now as tactical and time-limited, and a year from now, we won't care about these things. It's just a matter of now understanding the big vision, and how do we as an industry move towards there. And it's all about, grinding and executing and delivering more tokens and more exchanges one after the other.
And I think one other piece that's important to institutional investors is having a qualified custodian, and actually making sure that from a digital standpoint, they're working with a digital asset custodian that's actually SEC qualified and that does protect them, right? If they're not working with an SEC qualified custodian, essentially they could lose their money. Yeah,
that's
right?
The infrastructure piece that I was
right.
talking
And
about.
so you need that for institutional investors to actually de-risk it to the point where they're comfortable sort of with the traditional method. And then same thing with transfer agent, right? So I know VStock transfer is getting into the space of being a digital asset transfer agent. So right now, if you have a 2,000 investor limit before you trigger 12G reporting, which is pretty strenuous, reporting requirements. And so if you're not working with a transfer agent, you can't go over those 2,000 investors. If you do, you have this big burden of reporting and costs that you have to bear. And if you don't, 2,000 investors does not make a very liquid or high volume market. And so, that's another issue that needs to be solved as some of these traditional folks, I know ComputerShare is looking at moving into the space too, even though they're very traditional and the biggest transfer agent out there. they're now seeing the value of moving into space and becoming a digital transfer agent for that exact reason.
Ami, you mentioned issues with Ethereum. In terms of privacy concerns, are there any compelling reasons to use permissioned or private distributed ledgers like R3's Coda or Hyperledger's Fabric versus the Ethereum?
I personally think that there isn't a platform suitable for blockchain today, suitable for security token in the market today. I've actually started working on a new project or concept at this stage that will be talking about what would a blockchain look like if it was built from the ground out for securities. Okay, then it would have all the things that we around this here we see it as things as clear. I mean, you can't have anybody that's anonymous. Everybody have to be identified, KYC, AML. The assets themselves have to go through some sort of equivalent to KYC, which I call KYA. Somebody needs to look at the asset and see that it's real. You need to have privacy. You need to have regulations. None of this is in any of the existing blockchains. So I started working on this new project, and the idea is to define what would a blockchain look like so that maybe we can have it a year or a year and a half from now, and we don't have to rely on something like Ethereum. There are other solutions in the market, other blockchains that say that they can do this, but none of them was designed specifically for this use case. And I think that's part of the problem. So I'm not saying Ethereum is not good for now. It's an OK solution for the next 12 months, for the next 24 months. But if you want institutionals to come in, if you want to replace NASDAQ with an underlying blockchain, it's not going to work on Ethereum. You need something dedicated.
Abel, did you have thoughts on that as well?
Yeah, look, I mean, I think privacy is a big deal, especially as you get at an institutional level. They don't want their details out there. So either you're keeping it on your own private servers, behind this sort of firewall, if you will, or you have some sort of permissioned private blockchain where you're able to have a certain group, right, that has been KYC, AML, that is sort of qualified to participate in it. And then, a lot of those details are kept, the transaction details are kept more private versus sort of the ethos of Ethereum, which is complete 100% transparency. And so, which is a great concept in theory, but when you get down to the practicality of it, there's a lot of confidentiality involved, with institutional investors that, you need to address.
No, when we built our tokens, what we did is we in order to preserve the privacy of the token holders, on the blockchain, we only put the hash of the details. And the details are actually kept on our servers. Right. So the details are actually not on the blockchains because of this privacy. Mm-hmm. And it's a problem because you can't do everything on the blockchain because of the existing limitations. So and that's why I call it an OK temporary solution. We find solution to the privacy problems. It's not ideal. Maybe it's not scalable. But the solutions are there. So we do have, unfortunately, there are 5 competing protocols for security tokens on Ethereum right now, and we'll see which one wins.
So beyond tokenizing, what are the other benefits that blockchain technology can bring to, say, the real estate transaction?
I mean, one I'd say is, you've got an immutable, record that can't be, no one can go back and change. It's tamper-proof versus, a lot of times offline records right now. There's much more able to be manipulated. So I think that's one of the biggest changes, or biggest advantages from a record-keeping standpoint, is it's set. And once it's the record, and there's this auditable trail all the way back of every single transfer, every single activity that's occurred. And so to me, that's a big deal from a just being able to make sure that the information is accurate, the transaction details are accurate, and it's not being tampered with.
Yeah. I mean, I agree. I think fractionalizing assets is a big piece. That's really one of the newer innovations that tokenization allows for, and also the tracking side of things. I think those two, along with what you just mentioned and the security around it. So these are sort of the themes that you'll hear over and over again, and I think this is why you can make the argument that anything can be tokenized. But there are definitely certain things that work well for it, and I think the fractionalization piece is something interesting to think about if you're building something. Is it something that could or should be fractionalized, and would that help the product or not? Mm-hmm.
All right, so we'll open it up for questions in just a minute, but before we do that, I'd like each of you to offer one piece of advice for those in the room that are looking at the tokenizing of everything. So if someone here is involved in a project that is looking at tokenization, could you just provide them with one piece of advice?
Yeah, for me, understand debt. Know how the tokenization of whatever you're going to be doing will impact your ability to obtain debt at some point in the future or immediately.
For me, just to say that at this time, it's still complicated, so find a good company to work with that can take you by the hand, end to end, so you don't have to be the expert of, so you can just be the expert of your business, and you don't have to be the expert of security tokens as well.
Yeah, I mean, I think do your due diligence, retain, an attorney, possibly, and I agree. I think having a comprehensive end-to-end platform that has each of the different components that are actually necessary versus just one piece of the whole puzzle is extremely important right now, especially right now in these early years.
My advice would be to think long-term when you're thinking about tokenization. I think a lot of people, especially with all the hype from 2017, and now we're in this dip, and it's like people are trying to figure out, a lot of people are frozen in their money or in their investments, or they're trying to build right now and they're looking for money. So think long-term. Don't just tokenize something for the raise. Don't try to mash a utility token and a security token and a raise all together. Think 2, 3, 5, 10 years down, and is this going to help my company? Is it not? I mean, there is still something called venture capital. There's still normal equity. There's still, you can create a product that has, loyalty points. It doesn't necessarily have to be baked into blockchain. So blockchain tech can be integrated in a number of ways. You don't necessarily have to have a token. So just think about it pragmatically and, to try to figure out, is it the right move for you for the long term?
Great. So there's 2 mics here. If anyone has questions, please come up to the mic.
While we're waiting, I'm curious, what is something that everybody on the panel would tokenize? Something crazy. What's something crazy somebody would tokenize?
Crazy.
I've seen people talk about tokenizing football players.
Football players?
Football players. Wow.
Okay.
You want me to go real crazy or like
Yeah, what's something
mildly
crazy?
crazy? I think you could tokenize like talent, like human talent, and like what that does, and like tokenizing a person's abilities. That's way out there, but.
It's not way out there. For the football player, that's what they do, and I've seen several
think
projects
fantasy, right?
talking
You can
about
break it down.
Yeah.
You can.
So that you can tokenize a young player, and if they become the next
Exactly.
Messi or somebody,
Exactly.
good,
Yeah.
then you get a share.
Yeah, or music, music artist or whatever. So.
Does that involve the upfront? The player gets some of the money upfront from the
Yes, you
capital
get-
coming
you-
in, and then
you
if they
got
do
to-
well, it trades up. If they do poorly, it trades
They
down.
sell their equity,
Yeah.
human equity.
Yeah.
All right. Go ahead.
Hi, my name is Hazel Mann. I come from Realcomm as an advisor for the largest CRE tech trade organization. Also work for KBS Realty Advisors, 6th largest institutional office owner globally. A lot of what you've been saying is true. I see there's more interest on the LP side in liquidity. If you're a GP sponsor, why the heck would you allow LPs to have more control than you give them? I think it's really interesting because I deal with a lot of work order system with preventative maintenance. That definitely should be in blockchain. None of the top 3 SaaS providers are even talking about that. The other thing that should be in blockchain is leases. No one's talking about that right now. So I think in order to cross the chasm, I really think it comes down to you have to walk before you can run. At what extent do you think the firms in this industry are over-targeting and over-complicating when real estate really hasn't figured out some of the ground-level operational issues that should be on blockchain and can fairly easily put on blockchain today in order for them to trust that technology and translate it to a more investment management aspect?
I mean, I think it comes down to education, right? If you understand something, it de-risks it, and so by I think all of us are probably on the same page with that. A major goal is how do we educate, the different audiences into what this is, how is it valuable to them, why should they do this, and as you do that, I think there's, the feeling of risk and fear of trying something new starts dissipating as people understand it.
No, I think it's really, you're right, it's really hard and really complicated. And that's why we want to fund the crazy people that go ahead and do it.
For real estate specifically, if you're asking, I would say don't do title. There's so many companies that have failed, and there's a lot of reasons why. Leases are a really good way to start. Debt is also a really good way to start. Propeller out of New York is the first one doing debt. Really interesting concepts. But yeah, don't waste your time on title. You'll not be happy with VCs, or VCs won't be happy with you.
Go ahead.
Hi, my name is Jeff Packard. I'm fairly new to this industry, so forgive me if this is a silly question, but I'm curious about the capital stack when you're talking about real estate development and projects. Typically you have an equity piece and then a debt piece, and so I'm curious as to how this fits in with that. Does it just go in with the equity, and if it does, how does a bank treat the debt when they're looking at that as equity?
Yeah, I can talk about that a lot, because that's what in 2014, 15, and 16, I did a lot of this stuff. Risk is super dynamic, right? And the way that banks can give you money, the cheapest cost of capital you'll have for 75% of your transaction is based on risk. Once you start opening it to the crowd, your risk is repriced. So it can dramatically impact the returns that you're getting. And that's kind of why I'm super hammered into debt and understanding it. It happened in early crowdfunding, where a lot of the crowdfunding companies, they were only able to offer very small returns because their cost of capital became extremely high. So a lot of those have failed. The ones that have stayed around have gone bigger. They've gone with more institutional investors, more things of that nature, besides Pier Street, which is owning the debt themselves. So yeah, that's specifically with real estate.
Any other questions? All right, thanks for having us.
Thank you.